we wind up with what the Japanese call spinning tops. These are just small real bodies. And what's wonderful about the candlesticks is that they allow you to, they alert you to subtle changes in the markets, the supply-demand situation. So with the tall white candle, the bulls are in charge. The long black real body, the bears are in charge. As we get these diminutive real bodies, as shown here, it shows the market may be losing a little bit of force. Now, let me show you why, if you're trading with a bar chart, and it's to your credit that none of you are, but if you're trading with a bar chart, you're trading at a real disadvantage. Okay, here we have a chart, a bar chart, and based on this bar chart, the market looks fairly healthy. It's holding the highs very well. No reason for caution. Now, we take the same data as this bar chart and convert it into a candlestick chart. Remember, we use open, high, low, and close. See the different visual representation we're getting? Although the market's holding the highs very well, is it doing so with long white wheel bodies or with spinning tops and doji? Obviously the latter, correct? And what this is showing us is that the market may be losing some steam. And this is what unfolded after. Okay, obviously it's not going to work that well every time, but what's really important about the candlesticks is that although it uses the same data as the bar chart, it shows us the price. The candles show us the price, correct? Like a bar chart does, but the power, the potency of the candlesticks is they also show us the force behind the move. That's the difference between a bar chart and a candlestick chart. I guess you could mentally convert a bar chart into a candlestick chart, but why bother, right? It's done on the charts for us now. Years ago, when I was doing research into the candles in the 80s, no charting systems had candlestick charts. I had to draw them all by hand. Okay, now all the charting packages have candlesticks. So this is what we're going to be looking at today, reading how to gauge what the candles tell us about the momentum of the market. So although the market's descending here in this blue circle, what's happening with the bearish control of the market? Gauged by the real bodies. What's happening with those real bodies in the blue circle? Getting smaller and smaller, exactly. Now, I don't know, I might be buying here because the market seems to be stabilizing. Normally, if we have, let me go back here, I would not be selling short here. As we progress in the seminar, we'll be talking about using candlesticks to initiate a new position as opposed to using candlesticks to offset a position. But based on this slide, I would not be shorting here. It's rare for me to recommend going counter-trend with a new trade based on a single candlestick line. Something like this I would use to lighten up on long positions, move up stops, take some profits. Now, getting to this slide, it's not so much the real bodies that are making me less bearish. I might actually think about buying here because just as you would on the bar chart, what's going on? What's happening to the lows? Right. You see, we're going from lower lows to the same lows, and then we're making higher lows. So the market's making a rounding bottom. And what's nice about this, although there are no specific candlestick signals, is we have a very clean-cut stop-out level. We'll talk about trading psychology a little bit later. There's not really a course in trading psychology, but my feeling is whenever you're going to place a trade, set a stop before you place the trade. That's when you're most objective. So it's the same information as the bar chart, but because it's drawn a little differently, we get volumes of more information, volumes and volumes of information that you just don't get with a bar chart. And sometimes a little difference, and that's all this is. It's the same data, but it's drawn differently. Sometimes a little difference makes a big change. So with that in mind, I have this slide. Okay, a different perspective changes the whole picture, and you're going to have to watch this as I progress. Okay. I'll go back. Some of us, it looks like a face, right? And now it doesn't look like a face. Different perspective. Now we're going to look at doji. Okay. A doji is when the opening and closing are the same. And doji are particularly potent at calling reversal signals. These are all representations of doji. And with the doji, the Japanese would say the market is tired. And it's often a turning point. Okay. Now, a lot of people misuse doji. Let me show you an example of one of the ways they may misuse it. Okay. First of all, who's in charge of the market during this ascent? The bulls, right? Anything different? Yes, the doji. Now, one of the ways people misuse the candles is they equate doji with sell short. Wrong. A doji means that the market has gone from up to neutral, not up to down. By being neutral, the odds of the turn have increased, but they're not 100%. To me, the odds of a turn are lower here than they would be over here. Okay, technical analysis, when using technicals, we're really trying to get the probabilities on our side. It's never going to be 100%. Okay, here is another small wheel body. Now, I want to show you this slide for a couple of reasons. First of all, to show that some charting packages will not have black and white for the candles, right? It might be white and blue. Another reason is that the red circled area, although it's not a perfect doji, see, because the opening and closing aren't exactly the same, especially in the Forex market, I would view it the same as a doji. And we'll look at why that's important in a minute or two. Yes?
Where's your confirmation of a market turn on that first doji?
Okay. The question is, it's a great question, where's the confirmation